An asset puts money in my pocket. A liability takes money out of my pocket. We focus on the word literacy and not financial literacy. What defines something to be an asset or a liability are not words. In fact, if you really want to be confused, look up the words asset and liability in the dictionary. I know the definition may sound good to a trained accountant, but for the average person, it makes no sense. But we adults are often too proud to admit that something does not make sense. To us young boys, Rich Dad said, what defines an asset are not words, but numbers. And if you can't read the numbers, you can't tell an asset from a hole in the ground. In accounting, Rich Dad would say, it's not the numbers, but what the numbers are telling you. It's just like words. It's not the words, but the story the words are telling you. If you want to be rich, you've got to read and understand numbers. If I heard that once, I heard it 1,000 times from my rich dad. And I also heard, the rich acquire assets, and the poor and middle class acquire liabilities. Here is how to tell the difference between an asset and a liability. Most accountants and financial professionals do not agree with the definitions, but these simple drawings were the start of strong financial foundations for two young boys. This is the cash flow pattern of an asset. The top part of the diagram is an income statement, often called a profit and loss statement. It measures income and expenses, money in and money out. The lower part of the diagram is a balance sheet. It's called that because it's supposed to balance assets against liabilities. Many financial novices do not know the relationship between the income statement and the balance sheet, and it is vital to understand that relationship. So as I said earlier, my rich dad simply told two young boys that assets put money in your pocket. Nice, simple, and usable. This is the cash flow pattern of a liability. Now that assets and liabilities have been defined through pictures, it may be easier to understand my definitions in words. An asset is something that puts money in my pocket. A liability is something that takes money out of my pocket. This is really all you need to know. If you want to be rich, simply spend your life buying assets. If you want to be poor or middle class, spend your life buying liabilities. Illiteracy, both in words and numbers, is the foundation of financial struggle. If people are having difficulties financially, there is something that they don't understand, either in words or numbers. The rich are rich because they are more literate in different areas than people who struggle financially. So if you want to be rich and maintain your wealth, it's important to be financially literate, in words as well as numbers. The arrows in the diagrams represent the flow of cash, or cash flow. Numbers alone mean little, just as words out of context mean little. It's the story that counts. In financial reporting, reading numbers is looking for the plot, the story of where the cash is flowing. In 80% of most families, the financial story paints a picture of hard work to get ahead. However, this effort is for naught because they spend their lives buying liabilities instead of assets. This is the cash flow pattern of a poor person. This is the cash flow pattern of a person in the middle class. This is the cash flow pattern of a rich person. All of these diagrams are obviously oversimplified. Everyone has living expenses, the need for food, shelter, and clothing. The diagrams show the flow of cash through a poor, middle class, and wealthy person's life. It is the cash flow that tells the story of how a person handles their money. The reason I started with the story of the richest men in America is to illustrate the flaw in believing that money will solve all problems. That is why I cringe whenever I hear people ask me how to get rich quicker, or where they should start. I often hear, I'm in debt, so I need to make more money. Cash flow tells the story of how a person handles money. But more money will often not solve the problem. In fact, it may compound the problem. Money often makes obvious our tragic human flaws, putting a spotlight on what we don't know. That is why, all too often, a person who comes into a sudden windfall of cash, let's say an inheritance, a pay raise, or lottery winnings, soon returns to the same financial mess, if not worse, than the mess they were in before. Money only accentuates the cash flow pattern running in your head. If your pattern is to spend everything you get, most likely an increase in cash will just result in an increase in spending. Thus, the saying, a fool and his money is one big party. I have said many times that we go to school to gain scholastic and professional skills, both of which are important. We learn to make money with our professional skills. In the 1960s, when I was in high school, if someone did well academically, people assumed this bright student would go on to be a medical doctor because it was the profession with the promise of the greatest financial reward. Today, doctors face financial challenges I wouldn't wish on my worst enemy. Insurance companies taking control of the business, managed healthcare, government intervention, and malpractice suits. Today, kids want to be famous athletes, movie stars, rock stars, beauty queens, or CEOs because that is where the fame, money, and prestige are. That is the reason it is so hard to motivate kids in school today. They know that professional success is no longer solely linked to academic success, as it once was. Because students leave school without financial skills, millions of educated people pursue their profession successfully, but later find themselves struggling financially. They work harder but don't get ahead. What is missing from their education is not how to make money, but how to manage money. It's called financial aptitude. What you do with the money once you make it, how to keep people from taking it from you, how to keep it longer, and how to make that money work hard for you. Most people don't understand why they struggle financially because they don't understand cash flow. A person can be highly educated, professionally successful, and financially illiterate. These people often work harder than they need to because they learned how to work hard, but not how to have their money work hard for them. How the quest for a financial dream turns into a financial nightmare. The classic story of hard-working people has a set pattern. Recently married, the happy, highly educated young couple moves into one of their cramped rented apartments. Immediately, they realize that they are saving money because two can live as cheaply as one. The problem is the apartment is cramped. They decide to save money to buy their dream home so they can have kids. They now have two incomes, and they begin to focus on their careers. Their incomes begin to increase. As their incomes go up, their expenses go up as well. The number one expense for most people is taxes. Many people think it's income tax, but for most Americans, their highest tax is Social Security. As an employee, it appears as if the Social Security tax combined with the Medicare tax rate is roughly 7.5%, but it's really 15% since the employer must match the Social Security amount. In essence, it is money the employer can't pay you. On top of that, you still have to pay income tax on the amount deducted from your wages for Social Security tax. Income you never received because it went directly to Social Security through withholding. Going back to the young couple, as a result of their incomes increasing, they decide to buy the house of their dreams. Once in their house, they have a new tax, called property tax. Then they buy a new car, new furniture, and new appliances to match their new house. All of a sudden, they wake up and their liabilities column is full of mortgage and credit card debt. Their liabilities go up. They're now trapped in the rat race. Pretty soon a baby comes along and they work harder. The process repeats itself. Higher incomes cause higher taxes, also called bracket creep. A credit card comes in the mail. They use it and max it out. A loan company calls and says their greatest asset, their home, has appreciated in value. Because their credit is so good, the company offers a bill consolidation loan and tells them the intelligent thing to do is clear off the high-interest consumer debt by paying off their credit card. And besides, interest on their home is a tax deduction. They go for it and pay off those high-interest credit cards. They breathe a sigh of relief. Their credit cards are paid off. They've now folded their consumer debt into their home mortgage. Their payments go down because they extend their debt over 30 years. It is the smart thing to do. Their neighbor calls to invite them to go shopping. The Memorial Day sale is on. They promise themselves they'll just window shop, but they take a credit card, just in case. I run into this young couple all the time. Their names change, but their financial dilemma is the same. They come to one of my talks to hear what I have to say. They ask me, "Can you tell us how to make more money?"